Welcome everyone to the Basics of Share Market course, and this is lecture number 1B. And today we will cover the topic that how businesses enter the share market. And this is a continuation of the first and the previous video where we discussed about how investing helps, that is, uh, why we should not save rather than why we should not save and we should focus on investing. I have discussed in detail about that, and if you haven't watched that video yet, I have given the link of that video in the I button. You can check that out. Okay. So today we will discuss about how businesses entered the share market through initial public offering, that is IPO. Okay, so let's start. So when a business enters the share market, it basically means that it gives opportunity to common people like you and me to get a shareholding in their company. Now, when a founder of a business looks for investment in his company, he will seek investment from professional investors, right? And the reason behind that is basically there are basically two reasons behind that. Number one is that professional investors can invest lump sum amount, like common people like you and me cannot give huge amount to a very pre-revenue kind of a startup, and we cannot take that huge amount of risk, but professional investors can take that risk. So founders will seek help from professional investors, and secondly, professional investors have the expertise in the business field as well, which we as common people might not have. So as common people, we have very less opportunity to invest in businesses. But share market is a very good way in which, with very small amount of money, if we have the knowledge of business and if we have the skill to analyze a business fundamentally, we can invest in businesses. So when a business enters the share market, it basically means that it gives opportunity to common people like you and me to get a shareholding in their company. So in simple words, the company goes public. This is what it is said. Okay, the company goes public. When the company enters the share market, we say that the company has gone public. Now, before going public, the company has already come a long way, which we will discuss now through a hypothetical story of one of my friend's business. So let's go. Well, this is not a real story. This is a hypothetical story made by me only. And this story will help you understand how investing in businesses actually work. And also it will help you understand how a business finally, after coming a long way, after covering a long journey, finally it enters the share market. Sorry. Okay, so let's start. Okay, so meet Amitavo, an optimistic first year college student. Within 2 months from the start of his college, he has a business idea in his mind. Why not have stylish Bluetooth headphones for college students at affordable cost? He also wants his own manufacturing unit and doesn't want to sell Chinese products and make his products completely made in India. So that is his aim, and he has a savings of rupees 6 lakh, but for the initial investment he will need rupees 4 lakh more. That is, for the initial investment he will need a total amount of 10 lakh rupees to kickstart his business idea, but he has 6 lakh rupees with himself. So he has a deficit of 4 lakh rupees. So the question in his mind is, from where do I get the rest of the money? So now he comes to his friend Shubhamoy and pitches his idea. Who is Shubhamoy here? And here Shubhamoy is none other than me. And Shubhamoy accepts the offer. So he says that I need rupees 4 lakh to start my business, and I promise you that we will make it big, and I am optimistic. And Shubhamoy agrees. He says, okay, let's build a big business together. So in this case, Shubhamoy acts like an angel investor, but he is actually one of the promoters along with Amitabh. Now there are two terms introduced here: angel investor and promoter. Who is an angel investor? An angel investor is someone who invests in the earliest stage of a business, in a business which is in its pre-revenue stage, which is in its idea stage. Okay, like the name suggests, an angel investor actually acts as an angel to the founder of a business who has an idea but doesn't has the money to kickstart the business operations. So the angel investor takes risk in the idea and takes bet in the founder, and he invests in the business. So in this case, Shubhamoy acts like an angel investor, but he is not an angel investor because he does not invest the entire amount, and the major amount is invested by Amitabh himself. 6 lakh rupees has been invested by Amitabh. 4 lakh rupees is what being invested by Shubhamoy. So he will be one of the promoters along with Amitabh. Now, who is a promoter? A promoter in a business is someone who starts the business. Okay. So in this case, Amitabh and Shubhamoy are the promoters of the business. So they are starting the business. Fine. The initial fund that they together raise to kickstart the operations is called the seed fund. So another new term introduced here is called the seed fund. What is it? It refers to this 10 lakh rupees, that is the initial investment. Any initial investment for a business which is required to kickstart the business operations is called the seed fund. Okay. Now they registered their private limited company under the name of Amitabh Hearables Private Limited. Okay. Since the number of founders here is 2, therefore the registration of the company is a private limited company, and according to my knowledge, I think if the number of promoters exceeds 7 or more, then the registration should be under public limited. Otherwise the registration should be done under private limited. Okay, let's move ahead with Amitabh's business. Now before moving on to the business, we need to know about a concept of face value. What is face value? Now let's look at the boring definition first, and as usual we will make it interesting later. Face value is the price of each share of the company at the beginning, that is at the time when promoters and angels have bought. So it is quite self-defining, right? Face value is actually the price of each share of the company. Okay, now it is decided at the beginning by the promoters only. Now it should be a multiple of rupees 1, like the face value could be rupees 1, rupees 2, rupees 3, rupees 5, rupees 10, 20, 50, anything, but it should be a multiple of rupees 1. Now let's say in this context Amitabh Hearables Private Limited has a face value of rupees 5. Let's say Shubhamoy and Amitabh have decided to keep the face value as rupees 5. That means each share each share of the company of Amitabh Hearables Private Limited costs you rupees 5. Now since in this initial stage there is no asset of the company, there is no other money rather than the initial investment. So we take the total investment as the only asset of the company. Total investment is rupees 10 lakh. Pardon me if I mistake the number of zeros in 10 lakh. Okay. So if each share costs you rupees 5 and the total investment is rupees 10 lakh, then how many number of shares does the company have? Then in this case, the company has a total number of shares which is equal to 10 lakh divided by 5 equal to 2 lakh shares. So the company will have a total of 2 lakh shares. And now let's say if we decide that Amitabh has a 70% ownership of the company and Shubhomoy has a 30% ownership of the company in the beginning, then Amitabh should have 1,40,000 shares of the company, as 70% of 2 lakh gives you 1,40,000. So 1,40,000 shares will belong to Amitabh and rest 60,000 shares will belong to Shubhaman. This is how it works. Now in this business world, nothing will work as a mouth promise. So there's something there should remain a proof of it. So there must be some proof, and this is recorded in something which is called the share certificate. So the each promoter, where is my cursor? Okay, each promoter will have the share certificate, and in that they will have the name of the promoter, the face value of the company, and the number of shares allotted. That is name of the name of the promoter Amitabh. Face value is rupees 5. Number of shares allotted 1,40,000. This is how it works. Now the share certificate could be in physical format, like it could be in the physical form, or it could also be in online form, which we call as dematerialized form, that is demat form. Demat. Okay. And you can check that whether a company has some of its share certificates in physical form or not in their annual report. Okay. Now, with the concept of face value being understood, let's move ahead with Amitabh's business. But let's quickly recap the face value concept again. So the face value is the price of each share of the company, which is decided by the promoters at the beginning, that is at the start of the company, and it should be a multiple of rupees 1. Okay, that is face value. And remember, you should have this concept of face value in your mind and should note this in your copy, because this concept will be used later as we discuss the concepts like stock split, bonus shares, etc., dividend. Okay, so then also the concept of face value will be used. Okay, with that being said, now let's move ahead again with Amitabh's business. So Amitabh's business was kick-started with 10 lakh rupees, 6 lakhs being given by Amitabh and 4 lakh being given by Shubhaman. So Amitabh hearables generate revenue and make profits. And after 1 year, Amitabh decides to raise 1 crore for Capex, that is capital expenditure. Now, what is Capex? We're coming into it. Before that, what happens in the story here is that after the start of the business, 1 year has passed, and now the company has started its sales and it is making profits as well. And now Amitabh is deciding to expand his business, and for expansion of his business he will need 1 crore rupees for capex. What is Capex? Capex is capital expenditure, that is, it is the expense of a business for any kind of its expansion. Like it could be the expense for buying a real estate, it could be the expense for, you know, buying a manufacturing unit, it could be any expense that falls under expansion for the business. That is Capex. So Amitabh decides to raise rupees 1 crore. Now comes into the story the venture capitalists. So the venture capitalists come and invest, and the valuation of the company increases. Who are venture capitalists? Venture capitalists could be regarded as the big brother of angel investors. Okay, so angel investors and venture capitalists. Venture capitalists are someone who invest in early stages of business, but not as early as the angel investors do. Okay, since the venture capitalists are investing in the business when the business is generating some revenue and is promising something, therefore the risk is now less. So the angel investors took more risk than the venture capitalists, and the venture capitalists have lesser risk. Therefore, you cannot offer the same valuation of the company to the venture capitalists as you did to the angel investors. It would be wrong to the angel investors. So, like at the initial stage, what was the valuation of the company? It was 10 lakh rupees, right? Like that was what the company had. So this is not the way how valuation is counted, but if we do it in a very simple manner, that was what the company had, and we can call it as its valuation. So 10 lakh rupees was its valuation. Now as the company is generating revenue, Amitabh can pitch the business to the venture capitalists as at a higher valuation of the company. The venture capitalists might negotiate a bit, but they will definitely close the deal at a higher valuation than what done by the angel investors. And in this way, the angel investors will make a profit. Obviously, this profit is not a realized profit until they sell the shares. This is a notional wealth, what they make. So this is how you make your wealth while investing in businesses. This is why the angel investors take risk and invest in businesses. So Amitabh raised 1 crore rupees from the venture capitalists. Now, after 5 years, Amitabh Hearables is doing phenomenally well. And Amitabh is now a seasoned entrepreneur. Very good. So we have moved forward 5 years and it is a very stable company now. He now decides to take his business to another level and wants to raise rupees 50 crore for Capex. So after 5 years, Amitabh now decides to take his business to another a bigger level. Now he calculates that he needs 50 crore rupees for Capex. And now comes into the scene the private equity investor. Who is a private equity investor? A private equity investor could be regarded as someone who is like a big brother of venture capitalists. A private equity investor is someone who invests at a later and mature stage of a business, thus taking lesser risk, whereas venture capitalists invest in earlier stages and take more risk than private equity investor. Thus, therefore, the private equity investor has to offer a better valuation than what offered by the venture capitalists. because the private equity investor has a stable condition to invest in the company, and they have lesser risk, because the now the company has grown, right? Like the initially when the company was started and when the angels came, okay, the company was like a baby company. It was a bacha company, and the angels took the risk. Angels took the maximum risk. Angels took the risk max. Okay, and they took the bet, and their bet went right. The bacha company grew a bit, and then the venture capitalists saw potential in that, and they took risk which could be regarded as risk moderate. Okay, and now as the company has grown bigger and more stable, and it promises you to generate revenue year by year, to generate profits year by year. Now here comes the private equity investor who are taking the risk min. So therefore the private equity has to offer the maximum valuation, and when they offer the maximum valuation, the VCs will make the profit, and if the angel investors have held in this company for so long, they will also make the profit. In this way the VCs will make notional wealth. So this is how the investing in businesses occur. Okay, now in this context I would want to refer to something, that if you are also willing to start a business, it is not necessary that you have to raise funds for your business. There are some businesses which have grown to phenomenal heights without raising a single round of funds. Okay, some businesses have grown being bootstrapped, and they have grown like anything. A very good example of such a company could be Zerodha. Okay, it has grown to thousands of crores and it hasn't raised a single rupee till now. So it doesn't mean that whenever you are starting a business you have to take an investment from some investor. It doesn't mean. Okay, and I am not influencing you that you have to take investment when you are starting a business. Now since the Shark Tank show has come, people are more prone to taking investment in their business, and that's not the best way to grow your business. Okay, that seems fancy, but that's not the only way to grow your business. So with that being said, now we understand how investing in businesses occur. So now this expenditure for capex could be fulfilled by Amitabh in other ways also. Not necessarily he had to take investment from private equity or venture capitalists only. He could take a loan from the bank also. Okay, and he could also bootstrap. Like what does bootstrap mean? He could use the profits generated by the company and use those profits to grow the business. He could do that as well. Now while doing that, the growth is slow but steady, and while but many companies do that. They don't want to dilute their company. Okay, whenever you bring more owners to the company, you bring more pressure on your shoulders. Okay, so now 50 crore rupees have been raised by Amitabh from the private equity investors. So the private equity investors and VCs, what is the difference between them have been discussed. Now fast forward 6 years after the Series B round from PE investor, Amitabh Hearables is now the most trusted headphones brand in India. Now what is Series B round? Series B round refers to that when a company raises investment after the seed fund, The first round of investment should be regarded as Series A round. The second round should be regarded as Series B round. Third round should be regarded as Series C round, and so on. So the first round, which Amitabh Hearables took the round from the VCs, should be regarded as Series A round. Second round was invested by PE investors, so that was Series B round. So after the Series B round and after 6 years from that, Amitabh Hearables has grown a lot and it is now a brand which is most trusted in India as a headphones brand. Amitabh is now planning to take his business to the international level now. But for this, the Capex requirement is huge, that is 400 crores. He can arrange this requirement from the following options. Okay, so he now has to arrange 400 crore rupees in order to arrange this Capex requirement. Now, for going global, you have a huge requirement. So he needs 400 crores. What he can do is that he can use the internal accruals, that is, he can use the company's profits and use them only to grow the business. Number two is that he can raise the Series C round from PE fund. Number three is that he can raise a debt from bankers. What is debt? Debt is nothing but a loan. He can take a loan from the bank. Now, since this is a very stable company, the banks will be happy enough to give a loan to such a company. Number four would be like he could float a bond. Now, what is a bond? Bond is just another form of raising a debt. And the fifth form is what he can do is he can file for an IPO, that is initial public offering, that is he can enter the share market. Okay, and number six is that he can do a combination of all of the above. Not necessarily he has to do only any one of these above. Okay, he can do a combination of the above also, like he can take 50 crores from here, he can raise 50 crores from Series C round, he can take 50 crores loan, and he can take how many left, I would say 250 crores left, right? 250 crores from IPO, he can do that as well. That's his choice. So what does Amitabh decide? Amitabh decides to file for an IPO. Now, the reasons being he wants to avoid debt, because the debt comes with an interest and he doesn't want to bear that, and he also wants to offer exit for his early investors. Thus, we now have understood that how mature businesses enter the share market through IPO, and they, in most of the cases, entered the share market through IPO to meet their huge capex requirements. Okay, there could be some exceptions as well, but this is what happens in the majority cases. Okay. So the story of Amitabh Hearables ends here. Now to file for an IPO, the company has to follow a lot of steps also. We will not dig deep into which, because that's not our field of interest, because we are viewing share market as an investor's point of view. And you know what the company has to do, the company has to go to a merchant banker, it has to take permission from SEBI and blah blah blah. So we will look IPO a little bit more from the investor's perspective. So what's important from the investor's perspective is that there are two types of securities markets. Okay, number one is the primary market, which is also known as the issue market, and number two is the secondary market. Now, what are these markets? These are the share market. What we call the share market are these two markets. Okay. Now, what happens in the primary market and the secondary market? What are the differences? Now, in the primary market, As the name suggests, it is the issue market. When a company lists for the first time, okay, it comes in the, say a company is here, it comes in the primary market, okay, for the first time, when it lists for the first time. And in the primary market, the transaction is directly in between the investors, that is like common people like us. Could be other high net worth individuals as well. And the transaction is between investors and the company, like there is no middleman. So the transaction is directly between the investors and the company, primary market, in the primary market. So when does a company enter the primary market? When it comes to the share market for the first time, that is during the IPO. So when you invest in the IPO, you are actually paying the money to the company directly. You are not paying to anyone else. Okay. The transaction is between the investor and the company. After listing, the company is then listed to the directly, it is then listed to the secondary market. And secondary market has got BSE and NSE. BSE is Bombay Stock Exchange and NSE is National Stock Exchange. Now what are Bombay Stock Exchange, National Stock Exchange, CDSL, NSDL, SEBI? All of these will be discussed in the later videos of this series. For now, you understand that BSE and NSE are like the dukan, the markets, where the shares of this company will be traded later on after it is issued for the first time. Okay, so after it is issued for the first time, it then goes to the secondary market where it is traded between investors only. So now when it goes to the secondary market, now if you buy a share of the company, that means someone is selling that share at the price at which you bought it. And here the transaction is between two investors. That means whenever in the secondary market you are buying shares of a company, there is someone on the other end who is selling the share of the company at that price. And again, in the secondary market, whenever you are selling the share of any company, that means there is someone at the other end who is buying the share of the company at that price. The transaction is always between two investors, and that is fulfilled by BSE and NSE. Like there is a more complicated and detailed process in it. We will discuss about it. But BSE and NSE are the dukan, the market, where you get to purchase the shares. So this is what primary market is. This is what secondary market is. So we got to know about it. Okay. So let's quickly recap. So the transaction happens directly between the issuer company and the investors during IPO through the primary market. And after the IPO, when the company is listed, it is traded in the secondary market through NSE and BSE, where transaction happens between two investors. And NSE and BSE act like a dukan. Okay. Now we have come to the last part of the video, where some terms involved while applying for an IPO will be discussed. Like when you are going to apply for an IPO, like you have done research for a company which is going to be listed and you want to apply for an IPO, then there will be some terms which you will come across, such as minimum quantity or lot size. Now these are not the same terms, but these refer to the same amount actually. What is minimum quantity? Minimum quantity is the, as it suggests, the minimum quantity of shares that you will have to buy or you will have to apply for when you are applying for the IPO. Okay. And what is lot size? Lot size is the number of shares in one lot. Like when you are applying for an IPO, you cannot apply for one share or two share or three shares. You have to apply for lots. Either you apply for one lot or two lot or three lots. You have to apply in lots. Now, how many shares will each lot contain? That will depend upon what the price range of these shares are decided by the company. But each lot will cost you around rupees 15,000. It could be something less or something more, but it will cost you around 15,000. So let's say if each share cost you around rupees 50, therefore how many shares do you get in one lot? You get around 300 shares, like 15,000 divided by 50. So in each lot you get 300 shares. So when you buy one lot, you get 300 shares. You buy two lots, you get 600 shares. It works like that. You cannot buy one share, you cannot buy two shares. You have to buy 300, or you have to buy 600, or you have to buy 900. You have to buy in multiples of the lot. Okay. Actually, you don't buy, you actually apply for, and then it depends upon your luck and the supply and demand that it will be, you will get the shares, you will be allotted the shares or not. Now price range, as already discussed, the price range of the shares is the range of price decided by the company which will be for the shares. Like if the company decides the price range would be 50 to 55, that means each share you will get for 55 rupees if you are allotted at max, at a maximum rate of 55 rupees. So that is what price range means. This is decided by the company itself. Issue size refers to the total amount of, how big the issue is, like what is the total amount of investment that is to be raised through this IPO by the company. That is the issue size. And offer start is the date on which you can apply for the IPO. Okay, that is the offer start date. And offer end date is the date till which you can apply for the IPO. Like there is a date range between which only you can apply for the IPO. You cannot apply before or after that. Allotment is the date on which the people who have been allotted the shares are allotted. It sounded funny. Like say not all the people will be allotted the shares. Like if the company has decided to dilute 2 lakh shares, and if the number of people applied for the IPO are 3 lakh, then it is not possible for the company to offer 3 lakh people all the shares, because they are here to offer 2 lakh shares only. So there will be 1 lakh people who will not be allotted the shares, and there will be only 2 lakh people who will be allotted the shares. So on the date of allotment, the people who will be allotted will be allotted, and the rest of the 1 lakh people in this example which I am taking, that the rest of the people who are not allotted will be refunded their amount on the refund initiation date. Like they will get back their money to their bank account. And demat transfer is the date on which the people who have been allotted their shares will get the shares in their demat account. What is a demat account? It is an account in which you keep your shares. It is like a locker. Okay. And finally, the listing date. Listing date is the date on which the company's shares are listed in the secondary market. Okay. So on the listing date, the price at which the company's shares are listed is called the listing price. Listing price. So if say you applied for the IPO at rupees 55, and the listing price is say rupees 80. So you make a profit on day one itself, and such a profit is called listing gains. Listing gains. In this way, many people make profits from IPOs as well. Like, that doesn't mean every IPO will give you profit only. Some IPOs may give you losses also. It depends upon demand and supply and also many other things. So you need to do your own research before applying for an IPO. And a very good strategy for IPO investing has been discussed by Pranjal Kamra, the video of which I will pin down in the description. You can check that out, and you can also form your own strategy around it. So this was it for today's video. I hope you gained some value from it, and this is how this course will go. And probably in the next video we will know about all the intermediaries involved in the share market. So thank you for being till the end, and you can share your feedback through the comments. Thank you.